Good afternoon, and call the hearing to order. Today we're going to meet to examine the challenges small employers face in saving for retirement. Americans have always found it difficult to save. In June, a Bankrate.com survey found that 76% of Americans were living paycheck to paycheck. As our workforce ages, life expectancies increases, and the future of the Social Security program still remains in doubt. With that, saving for retirement seems more important than ever. Small employers understand the importance of providing good benefits, including retirement savings options, to attract and retain some quality employees. However, in today's economy, that can be very challenging. And the Government Accountability Office recently reported that only 14% of small employers sponsor a retirement savings plan for their employees. Some small business owners have said offering retirement plans is just too complex or too time-consuming. Surveys by the Transamerica Center for Retirement Studies, whose president is testifying today, have found that small businesses continue to lag behind large companies in sponsoring retirement options. Small business confidence polls have shown that the economic recovery is still uneven, and entrepreneurs and their employees may not be saving more for retirement. We look forward to the new data that Transamerica is releasing at today's hearing, as a matter of fact. And during this hearing, we will explore the state of retirement savings by small businesses and their employees, the barriers they face, and how we can encourage more small businesses to offer these important benefits. And I do want to thank all of our witnesses for being here today, and for some of you traveled a long ways, and we appreciate that very much. And with that, I'll turn to Ranking Member Velasquez.
Thank you, Mr. Chairman. Retirement security is a universal goal for most Americans. As part of that retirement plan, most Americans rely on employer-based retirement plans. As the baby boomer generation ages, it is critical that small employers and their employees have financial security as they enter their retirement years. But the problem remains that only 14% of small firms offer such a benefit. With 99% of all businesses in this country being small businesses, if we're truly going to make retirement security a reality, we must address their needs. Small firms not only face the challenge of offering a retirement vehicle, but enrolling their employees. Roughly 50% of the private sector workforce participates in an employer-sponsored pension plan. While much of the problem can be attributed to a lack of employer offerings, nearly 20 million workers actively choose not to participate in plans offered by their employers. Improvements to the retirement system must meet the needs of business owners, while also encouraging more workers to participate. It is clear that small firms face many obstacles when setting up a retirement plan. First, there is the cost of selection and administration. The costs do not stop there either, since employers are required to make matching contributions much of the time. Finally, small firms face ongoing fiduciary duties, such as reviewing investment and running discrimination tests, all while trying to run a business. Our system seems to almost discourage small businesses from offering retirement packages and helps explain the inequity in coverage rates for workers at small and large companies. It is clear that to encourage small businesses to start offering plans, something needs to be done to address this obstacle. Small employers face too many challenges and simply will not offer a retirement plan if they perceive that the burdens outweigh the benefits. Understanding these challenges can help us better address the solutions to low participation rates among small entities. One approach may be to offer increased tax incentives to small business owners who choose to sponsor a plan. Another method to encourage workers to participate is to create an automatic enrollment IRA. These and other ideas merit further discussion, but one thing is absolutely clear. We must act soon to help small businesses and their employees plan for their future. For these reasons, we need to make sure that retirement plans are attractive for small businesses, as their retirement saving is integral to our nation's future, and that is why we're here today. This hearing will allow members of this committee to discuss the current vehicles that many small businesses use to provide retirement benefits and ways in which they can be improved upon. With the proper tools, America's small firms can sustain the economic growth currently underway simply by investing in their futures. And with that, I thank all the witnesses for being here today, and I look forward to your comments. Thank you, Mr. Chairman. I yield back.
All right, and our first witness today is Cathie Collins, who is the president of Transamerica Center for Retirement Studies in Los Angeles, California. She is a retirement and market trend specialist and oversees all of Transamerica research and outreach activities, including its annual retirement survey, which is being released today at our hearing. We appreciate you coming all this way, and thanks for being here.
Well, thank you and good afternoon. I'm Cathie Collins, president of the Transamerica Center for Retirement Studies, or TCRS. Today, TCRS released new research as part of its 14th annual Transamerica Retirement Survey of 750 employers and more than 3,600 workers, including those from small companies of 10 to 499 employees. Employer-sponsored retirement plans in small business play a critical role in facilitating savings among American workers. TCRS research findings underscore the importance of these benefits in helping workers prepare for retirement. 88% of small company workers value retirement benefits as important. I'd now like to share 4 key findings from our research. Number 1, plan sponsorship rates offer room for growth. Plan sponsorship rates, which may come as a surprise, are already relatively high. 71% of companies with 10 to 99 employees offer a 401k or similar plan, such as a simple or SEP, and nearly 9 out of 10 companies with 100 to 499 employees do so. But more can be done, especially for the smallest of companies. Nearly 1/3 of small companies that do not offer a plan say they would be likely to consider joining a multiple employer plan, which is a type of group plan offered through an entity that handles many of the fiduciary and administrative functions. Key finding number 2, plan sponsorship often does not lead to coverage for part-time workers. Plan sponsorship is not necessarily synonymous with plan coverage. A critical component of expanding coverage is encouraging employers to extend eligibility to their part-time employees. At small companies, only 36% of part-time workers are offered a plan, compared to 68% of full-time workers. Key finding number 3, few companies use automatic enrollment. Automatic enrollment is widely recognized as one of the most effective ways to increase plan participation. However, only 19% of small companies take advantage of it. The median default contribution rate is just 3% of annual salary, which is insufficient to ensure a participant's secure retirement. Key finding number 4, most small business workers need to save more. The majority of small company workers plan to work past age 65, and the majority plan to continue working after they've retired, mostly for income-related reasons to bridge savings shortfalls. Perhaps the ultimate measure of a worker's retirement outlook is his or her level of savings. In 2013, the estimated median household savings in retirement accounts among baby boomers, which is the generation closest to retirement, is just $92,000 for small company workers. It's clear that small business workers need to save more, and tax incentives are powerful motivators for saving. Yet few small company workers are aware of the Savers Credit, which is available to low to moderate income tax filers who save in a qualified plan or IRA. In light of these research findings, TCRS offers the following 5 recommendations. 1, expand tax incentives to help offset the costs for small employers to establish a new retirement savings plan. The current startup tax credit only allows small businesses to claim up to $500 for 3 years. 2, for small businesses in which a standalone 401k plan is not feasible, make multiple employer plans, or MEPs, more attractive to small employers. MEPs should be simple to administer and provide safe harbors from fiduciary liability for each employer. In addition, small employers should be protected from liability-related errors by other employers who are participating in the plan. And tax incentives should be provided to encourage participation in these plans. 3, create additional tax incentives and safe harbors to encourage plan sponsors to expand coverage to their part-time employees. 4, increase the default contribution rates in plans using automatic enrollment. The current 3% minimum default contribution rate sends a misleading message to plan participants that savings at these levels is sufficient for a secure retirement. A new automatic enrollment safe harbor, under which employees are enrolled at 6% with increases up to 10%, coupled with a tax credit for adopting it, could drive up plan sponsorship rates as well as participant savings rates. And number 5, increase savings along low to moderate income workers by promoting the Savers Credit and expanding it so that more tax filers are eligible. In conclusion, TCRS commends Committee Chairman Graves and Ranking Member Velasquez on their consideration of the particular challenges and needs of small business. We appreciate the opportunity to share our views and research.
Mr. Chairman, it's my pleasure to introduce Ms. Paula Kalimath. Ms. Kalimath is the principal at the law firm of Paley Rothman, which is located in Bethesda, Maryland. She chairs the firm's retirement plans, employee benefits, and the government relations practice groups. Ms. Kalimath is testifying today on behalf of the Small Business Council of America and the Small Business Legislative Council. Welcome, and thank you for coming back to our committee.
And Ranking Member Velasquez for having these hearings today. As I think we all recognize, this is an extraordinarily important topic. The success of the private retirement plan system means the difference between a comfortable retirement and a not comfortable retirement. And so the work you're doing today, I can think of not many things that are more important than what you are doing. I'll be citing a number of statistics and data that will show that the small business retirement plan system is far healthier than people believe. So, for instance, the 14% number, I think the data that's been just released from the Social Security office is much more in line with the data that you just came up with. But the system is precariously balanced on tax benefits. And right now, those tax benefits are in line so that when a small business owner or owners decide whether they want to sponsor a retirement plan or not, they go through a cost-benefit analysis. And they determine what are the benefits to be derived to the owners and the business, and they compare it to the costs and burdens that they will have to undertake to sponsor that plan. And one of the costs, by the way, are the costs of making contributions for the employees of the company, because the tax code forces significant contributions to be made to those employees. Because of this, any significant cuts to the benefits that can be derived by the owners will cause small business plan formation to either be stopped, plans frozen, or new plans will not be formed. So it's critically important that steps that are taken by you all assist in that cost-benefit analysis by not overburdening the costs and increase the benefits, or at least leave the benefits alone. There are places where the system can be simplified. We have set forth a number of ideas in the back of our testimony. I hope I can get to them today. If not, I am more than happy to discuss them with you. For instance, one idea is that we could come up with some kind of lottery system inside a small business, for instance. So any employee who is willing to make a 3% contribution into the plan is entered into a lottery, and the names of the non-highly compensated employees only are put into this hat. One name gets brought out, and that employee would get maybe $500 or $1,000 put into their plan, or maybe made as a cash bonus to them. Sort of brings some excitement of why we want to save, kind of get people more excited about it. I think many times employees look at this as sort of almost like autopilot. And in fact, one of the things I'll talk about is that auto escalation and auto enrollment, which is where employees are literally just put into a 401k plan. They can opt out, but the numbers are startling. Very few opt out. And why? Well, we think it's because of inertia. It's easier to just stay in than take active steps to get out. And auto-escalation increases the amount that employee is putting in on this automatic basis. And again, the data is startling. People just let the amounts keep building up. So even at a 6% contribution level, so this is 6% being taken out of their compensation, they just stay in and let the 6% go in. And putting in 6% into your plan and letting it grow tax-free is a very good way to save for your retirement. In fact, it's such a good way that EBRI was asked to do some work for the ASPA, the American Society of Pension Professionals and Actuaries, and what they found was that workers are 14 times more likely to save in a retirement plan that's offered by their employer than they are to go and put money into an IRA. And that's a pretty significant statistic, 14 times more likely to save. I think we're all sort of brought up and know that our retirement security of this nation rests on the three-legged stool. The first leg is Social Security, a very fixed system, a defined benefit system. You can't outlive it. Very little flexibility in that system. And for many people, it is a major portion of their retirement. For others, it's a safety net. It's working. I think you all are going to have to fix it a little bit, but basically it's working. The private retirement system, even though highly regulated by Department of Labor and IRS, is much more flexible. And plans can be designed to fit a company's structure and what they perceive as will be most they can design it so that the employees will appreciate it the most, or it'll fit best with their own employees. And that system is working extremely well, actually. Part of it is payroll deduction. As I said, it's automatic. Employees don't have the money in their pockets. They can't spend it. They don't have to do anything. It just comes out of their payroll. It works really well in the 401k and 403b environment. Once the money is in the plan, it is difficult to get your hands on that money, which is one reason why the account balances tend to grow. If people are putting their money into an IRA, they can walk into that IRA and then to the bank and take money out. It's much harder in the 401k or 403b environment. So I think I've gone past my time, but I'll be happy to take questions. Thank you.
Thank you very much. Our next witness is C. Roy Mesik, who is the certified public accountant and qualified plan administrator with TPP Retirement Plan Specialists in Overland Park, Kansas. Mr. Mesik has been a CPA for over 30 years, and he's responsible for coordinating TPP's retirement plan record-keeping, consulting, and administrative services. His firm is a small business serving a lot of small business clients. Thank you for being here.
Thank you. Chairman Graves, Ranking Member Velazquez, and members of the House Committee on Small Business, I appreciate the opportunity to be here. It is an honor and my pleasure to have some input into the process. Like Representative Graves said, I am a CPA and a qualified pension administrator as recognized by the American Society of Pension Professionals and Actuaries, or ASPA for short. I head up our retirement plan division, TPP Retirement Plan Specialist, which is a subsidiary of TPP Certified Public Accountants located in Overland Park, Kansas, also with an office on Long Island, New York. We administer approximately and/or record keep 400 plans across the country, primarily 401k and 403b plans. Probably 90% of those are under 100 employees, so I understand small businesses and the challenges they face in setting up these plans. In my written testimony, I did summarize the types of plans that are commonly offered to small businesses, primarily 401k plans. I'm not going to go into that in detail. But in my over 30 years of experience, I've seen there's a lot of reasons why employers do set up plans and a lot of reasons why they don't, some of which have been touched upon already. Well, why do they set them up? Let's talk about that first. First of all, employee retention and recruiting. It is a huge benefit. If you have a 401k plan, you need to go out there and get talent. You got to have a 401k plan. And I also think a lot of businesses, it's really kind of a paternalistic, maternalistic instinct. I mean, they want their employees to have good retirement. I want our employees to have a good retirement. So I think that's a huge reason why these plans are offered. Tax incentives, of course. So much easier to defer on a pre-tax basis. It's just easier to save that way. The other nice thing about employer-sponsored plans is the contribution limits are higher than IRAs. You can put more away into a 401k plan than you can into an IRA. So that's good, too, for retirement. So that's another reason why they do. Payroll deduction makes it easy to save. I think we talked about that, but it's so much easier if that money's coming out of your paycheck versus you have to sit down on April 15th and write a check to your IRA. Much easier. Now let's examine why employers don't offer plans necessarily to their workforce. One, these things are complicated, subject to a lot of Department of Labor and IRS rules and regulations, and with complexity comes expense. So that can be daunting for some small employers. And it's also all about proportionate cost. For example, if you have $1 million 10-person plan versus a $50,000 10-person plan, same number of employees, totally different asset size, who's going to get the better deal? I mean, the record-keeping administrative cost is really about the same, whether it's the $50,000 plan or the $1 million plan. So it's all about proportionate cost. Same thing with investment advice. Now, our firm doesn't provide investment advice or do investments, but that is a huge component to a plan. The person who has to advise these 10 people takes the same amount of time, whether there's 10 of them, with $50,000 or 10 with $1 million. So that proportionate cost is a huge reason why some employers don't offer those. Not enough tax savings. Some employers won't offer a plan unless the tax savings more than offset the contribution for the employees. They just won't. Another reason might be why the business owner personally can't defer enough into the plan. In a traditional 401k plan, the amount that the business owner can defer is typically limited to 2 percentage points more than the average of the rank and file. So, for example, if the rank and file is deferring 4 percentage points on average, the business owner gets 6. That person makes $100,000 a year. They can only defer $6,000. They may say, hey, that's not worth it, not going to set up a plan. Now, in a safe harbor plan, that's a variation on a 401k plan. That makes that test go away, where the business owner can defer the maximum allowed by law, which is $17,500. But the trade-off is a required contribution of 3 to 4% of pay for the employees. That may not be able to afford that. Their finances may not be such that they can afford that. So that would be another reason why small business may not offer those plans. Well, how can we get more participation? I think those tax credits, that's been alluded to already, that's huge. If we can expand that tax credit, maybe target more towards smaller business somehow, some way, to get these people to help start a plan, I think that'd be great. I think the 401k and 403b deferral limit should actually be increased from the $17,500. I know it's a tax deduction, but it might spur some business owners to say, okay, hey, now I can put more away. Yeah, I think I'll do that. So I think that's something worth considering. Maybe another type of safe harbor 401k plan that doesn't mandate that 3 to 4%, maybe something a little bit less in return for maybe a lesser deferral limit for that business owner, kind of a compromise. Maybe something like that would help. So with that, those are my thoughts, and I appreciate the opportunity to be here and welcome any questions you may have.
Thank you, Mr. Mesik. Our final witness today is Rux Daschle, who is the Chief Financial Officer with Quest Tech Solutions Incorporated in Houston, Texas. He has over 40 years of wide-ranging financial and general operations experience with closely held and publicly held companies. Thank you for being here.
Thank you. Chairman Graves, Representative Velasquez, members of the House Small Business Committee, thank you for inviting me to testify today. As said, I'm here to testify to let the committee know that retirement savings for the small business employees is not just a necessity, they're a critical component of my company's ability to attract and retain skilled employees. As a representative of small business, we offer a 401k benefit to our employees since the company's founding in 2001. We're not alone in using 401ks as a recruiting and retention strategy. According to a survey conducted by ShareBuilder 401k, 89% of small business owners that offer 401k plans state that their benefit is an important factor for attracting and retaining the best talent. So why is this benefit so critical to Quest Tech? Questec is competing for employees in a marketplace where skilled workers are hard to find. These skilled workers are not just used in Houston. They're used in any place where the oil and gas industry is growing, West Texas, North Dakota, and they'll move for higher salaries or better benefits. And so we're competing with companies all over the country, some of which are much larger than us. Questec learned early on in its 401k benefit was easy to sell to prospective employees since we were matching 50% of their contributions. So why is Questec so generous with its 401k plan? It's simple. The cost is much less than training, attracting, and keeping good workers. Why? While 401k plan is important to Questec, there's a drawback to small businesses. 401k administration is very complicated. I have 40 years of experience in financial operations in small companies, and I don't have the time or the experience to manage 401ks. They're just too complicated. In addition, there's significant risk in managing 401k plans, and that risk and exposure can serve as a detriment for a small business to offer a 401k program. To avoid this risk and complexity, I have contracted with a professional employer organization to manage and administer my 401k plan. A PEO is a company that provides payroll, human resources, and employee benefit solutions to small and mid-sized companies. One of the services a PEO can provide is to its small business clients is access to its 401k benefits. By using a PEO to access 401k benefits, Questec no longer has the administrative burden associated with a 401k. My personal risk associated with being the administrator is minimized, and Questec is able to offer benefits that are competitive with much larger companies. I think it's important for the committee to understand that, in my view, administrative complexities of the 401k plan administration are the biggest obstacles to small businesses offering employee retirement services. I understand that the deferment of income for tax purposes is the primary reason for the 401k's complexity. I understand the need for strong fiduciary standards, and I understand the need for strong oversight. But this protection and this disclosure comes at a price, and that price is complexity and a significant burden for plan administrators. Congress should look at ways to both encourage smaller companies to offer retirement benefits to their employees and at the same time look to simplify and streamline the administration of such benefits. Education, outreach, and improvement to access of the retirement program, like the 401s, is very important. I also hope that this forum helps bring to the attention of the policymakers the challenges facing small businesses who want to provide these benefits to their employees and begin discussions on how to make these plans for small businesses to offer to their employees more successful. Thank you again for the opportunity to testify, and I welcome any questions you may have.
Thank you all for testimony. We're going to start with Mr. Kaufman.
Thank you, Mr. Chairman. I was a small business employer with 20 employees and offered a health care plan, but we did not have a 401k plan with a match. For those firms, to me, small business startups, particularly in the services industries that have 25 employees or less, that's a pretty daunting process. And so I think you mentioned some tax incentives to offset the administrative cost. Could you all go into what kind of incentives that you would see for the really small firms of 25 or less employees? Sure.
Sure, why not? Yeah, the $500, I think that's nice. I mean, it's a nice start for 3 years, but
Doesn't seem like a lot.
it's just not enough to jumpstart the bandwagon, if you will. It'd be one of those things you might want to try to maybe even double it, maybe even more than that, phase it down maybe, because if you can get them into the plan, they're not going to terminate it after a year or two, probably not, unless they really have some kind of adverse business situation. So maybe you make it tiered, start off high, kind of tier it down a little bit, get them hooked, if you will. So it's just my thought, off the cuff.
Anyone else? Yes.
Well, I'd say not so much the tax credit, though it's not like I'm against it. I think it's a great idea. But there are things you can do with the law which would actually help too. So, for instance, only small businesses are hit with these laws called the top-heavy rules. Today, I mean, this is really an accurate statement. Today, they're like an appendix in the human body. They don't serve any purpose, but they cause problems. And that's in the defined contribution area. I don't want to speak to the defined benefit area. But that is an extra additional cost on administration for small businesses that's truly unnecessary. Another thing would be to simplify the 401k tests, which is what you were saying. They can be made more simple. There was a proposal years ago called the URSA. Simplified it, would work out really well. A third idea would be sort of to go through the code and take out things which are aimed at small businesses exclusively. And in this regard, I'm thinking of like required minimum distributions, where only small business owners are required to take money out while they're working from a plan at 70.5. You know, just blatant discrimination to small business owners. So my answer would be work with the tax credit, but there's things where you could simplify that would really help.
Mrs. Collinson?
Okay. One thing I'd like to add to this, especially for these small companies of 25 employees, is the need to create greater opportunities for them to join a multiple employer plan, which is conceptually, it's a group plan with a plan sponsor that is an entity who is well-versed in retirement plans that can handle the fiduciary and administrative duties and take that off the small business owner's shoulders. So to facilitate the offering of those types of plans, and then even a tax credit for joining it, could help go a long way towards inspiring plan sponsorship among the smallest of companies.
Okay. Mr. Rux Daschle?
I've worked with small businesses my whole career, and the majority of the issues that come to bear for me when I have conversations about starting a 401k with a business is inertia. These businessmen don't get into business to run business. They get in business to buy something, sell something, manufacture something, provide a service. It's not to run a business. And so to talk about 401ks, they don't understand it. And so the risk involved far exceeds the benefit to what they perceive as their employees. They would like to help them with their retirement, but the risk to them. And so if we can minimize the regulation, the hurdles that they view as getting them into this process would go a long way.
Thank you, Mr. Chairman. I want to thank you all for testifying here today. I think it's as a former small business owner, and I think small businesses across this country, we really do need to have incentives for the owners and their employees to save for retirement. And so I thank you all for what you're doing, for testifying here today. I yield back.
Thank you, Mr. Chairman. Ms. Collison, your study noted that more than half of all workers feel less confident in their ability to achieve a financially secure retirement, and that 54% of workers plan to work after retirement. Given that older workers have been more adversely affected by the recession, would allowing older workers the ability to make larger catch-up contributions be something to be considered?
Thank you for asking. Anything that we can do to help older workers save more for retirement, especially understanding that many will not be able to retire at 65, can only help better prepare them, help them to help themselves better prepare.
And does your data indicate that older workers will make those larger contributions despite the decreased confidence in the financial markets?
That is an excellent question. And the first key to it is awareness. And I spoke in my testimony about awareness of the Savers Credit, which is still low among small company workers. It's 23% are aware of it. So to offer some sort of catch-up contribution above and beyond the current catch-up contribution or incentives one of the first things is to make sure that people know about it so that they can take advantage of it, and also look at it in the context of when they'll conceivably be collecting Social Security, because many workers plan to work past 65, past 70, are going to look to generate income from part-time work and may encounter some sort of conflict with Social Security if they need to start collecting benefits.
Thank you. Paula, one of the biggest challenges, and I believe that it was Mr. Mesik that made reference to that, is workers' retention. And we know that many small businesses want to provide a full range of benefits for their employees. And what we find is that employers realize that health care is generally more important to their employees and can be more attractive to potential hires. How often do you experience a small business owner allocating their limited employee benefit dollars to offering or improving health benefits in lieu of retirement savings?
Well, it's an excellent question, and is probably one of the biggest hurdles for small business owners. I think most of us who have been in the small business world know that the first 5 years of a small business's life is fraught with difficulty. And in fact, the Small Business Administration has told us back, I think using 2012 data, that 50% of all new small businesses don't make it through the first 5 years. So, the first 5 years are critical to getting stability. Then, as soon as a company can, it usually goes into the health insurance market. One reason why is it's the employees appreciate that benefit more than retirement plans. And one of the things I've been trying to figure out is how do you get employees to appreciate retirement plans more than they do today? Because particularly if you talk to younger employees, they would prefer a cash bonus.
Or how can we avoid creating an either-or situation for small business workers when it comes to these two priorities?
Right. Well, I
if
think
any of
that
the witnesses, the other witness, would like to comment.
Yeah, I think health care usually just wins. And then once the business gets a little more stable, a little more profitable, then the retirement plan. But this is an area where education across the board would be really helpful with employees realizing the younger they save, the better off they'll be.
Yeah. Mr. Mesik.
I'll talk about that a little bit too. There's no doubt that healthcare is number one. It's the big elephant in the room. There's no doubt that will always be number one. As far as being able to integrate a plan too, it's that issue is like you got to take care of the health insurance for your employees first, and then the qualified plan comes second. So that the issue is there something we can do to maybe take some of that burden for starting it up off that employer, so that they say, yeah, you know what, I can do this. I can do both. Start off small, and it gets better once you get some dollars into it, but that startup is tough.
Okay. I guess they're calling.
No.
I have time for one more minute. Mr. Mesik, borrowing against retirement is not always a good first option. Yet for small businesses having difficulty accessing loans, it might be their only option to reinvest in their business or create cash flow during difficult time, hard times. In your experience, does the ability to borrow from 401k plans and not in SEP and simple plans affect a small business decision to offer a retirement plan?
I think it does somewhat. I mean, there's no doubt that people like that, or a lot of employers like the ability to borrow from their account. Now, one of the things is, yeah, you can borrow up to half your vested account balance, 50 grand's the cap, and that's nice. The issue becomes, though, with the employees that borrow. I mean, you obviously have to offer that to them, too. I mean, that's only fair. But the problem is when they leave employment, they never pay those loans back. And then tax-wise, they get crunched. They're always under 59.5. So they have the 10% penalty. They're paying the federal tax and the state tax. They don't have much left for retirement. So I'm more concerned about that than the business owner being able to borrow to maybe help start his business.
Thank you. Yes.
One way of looking at loans is that the key is to get employees to save in their retirement plan, because we know that works. When you have the ability to borrow money, I think Psychologically, it makes employees think, I'll put in a little bit more because if hard times come, I know I can get this money back. So I think it actually is something that increases the amount of savings, is having the ability to borrow it if you really needed it. And borrowing from a plan, there's usually a cost involved. Most of the small business plans run through either a TPA or an institution, and there's usually, $50, $100 fee to borrow. So you're not going to go in and try to borrow $500 for something that's sort of not that critical when you know $100 is going to go right off the bat. So the money is usually not spent frivolously, I don't think.
Thank you. Thank you, Mr. Chairman.
Mr. Tipton?
Thank you, Mr. Chairman. Thank the panel for being here. Ms. Kalimath, could we maybe explore a little more on what the ranking member's question was in regards of either or when it comes to health care versus a retirement plan? Do you see a real challenge as we continue to see government regulations increasing costs on small businesses? Out of the Small Business Department, we have the statistics that we have $10,585 per employee in just regulatory costs alone that are being assumed by businesses. We're seeing the hourly wage right now of Americans actually being hurt based off of rules, regulations, and law redefining the work week in America from 40 hours to 30 hours. There was a time in this country when we fought to have a 40-hour work week. Now we're trying to fight to get a 40-hour work week back in this country. So do you see some opportunities? Do you have some advice for Congress to help get out of the way of business so that they can actually not be in that either-or sort of a situation, but actually to be able to take some of the resources that government is demanding to meet government regulations, government rules, and actually get it in the pockets of the people who are working hard and struggling right now?
There's no question that the cost of regulation and qualified retirement plan system is significant and could definitely be reduced. So, for instance, there's a number of groups that are trying to persuade Department of Labor that we should be able to have electronic delivery of notices. We're still, right now we're still doing paper delivery of notices. And if you were to see the amount of notices that a small business is supposed to give employees, not just in the qualified retirement plan area, but that alone is enough. But then when you get into health insurance and these other areas, literally there's like hundreds of notices required and all different dates. And unfortunately, most of these notices are very long, complicated types of notices that most employees don't even read. So it'd be far more effective to have electronic delivery. You could have big boxes and colors and, dollar signs, put money in the retirement plan, would get far more than 10 pages of fee disclosures, for instance. So absolutely, there can be a lot done to help us out here.
Great. Ms. Collinson, you deal with a lot of people. Are you seeing a trend now, given expanded rules, expanded regulations, and law, now to where we are seeing more and more people become part-time employees, actually hurting the American workforce, that this is going to really be discouraging employers and employees as well, because they aren't going to be able to get a 40-hour work week anymore. It's now 30 hours. From really participating in a retirement program?
Well, one thing that our research found is that in small business, in our survey sample population, the workforce was more likely to be a part-time employee compared to large companies. So part-time employees are widely used among small business, and so that's something to be very mindful of. We have not yet seen the trend that you're alluding to. Will employers start moving employees to part-time?
This is brand new coming in.
We're on the lookout for that. Have not seen that yet, but that's something that we're monitoring for in our research, given all of the news reports of it.
Great. Well, Mr. Mesik, you were alluding as well when small businesses, and we just heard great testimony, that are struggling, having a tough time, particularly those first 5 years, trying to do the right thing, because I'm a small business guy. Your employees become your family spend more time with them than you do with your family, actually. But when they're trying to do it, we're actually seeing government rules, government regulations, government law that are just making it prohibitive and complex to actually even put a program together to incentivize savings. Is that accurate?
Well, it is tough. I mean, there are a lot of rules and regulations, and you really have to hire somebody like me to figure it out, and I am appreciative of it. Thank you very much. But it's rough, and that's why I talked a little bit about maybe streamlining some kind of a simplified, safe harbor 401k. Maybe make it the required contribution a little bit less. Maybe you take some of the fiduciary liability off the table by just saying if you just invest in target date funds, you're good to go. I mean, there's some things you could do that would encourage small business, I think, to maybe offer some of these plans without it being hugely burdensome. Maybe a simplified 5500 reporting for that type of plan, a one-pager. And people will charge less then. I mean, we will. I mean, the marketplace will force us to, and I think that'd be good for these small employers.
We'll hold you to that, charging less.
You can. So. Well, yeah. We'll talk. Right. We'll talk. Okay.
Okay. Thank you, Mr. Chairman.
Custer.
Thank you very much, Mr. Chairman, and thank you for your testimony. I'm also a small business, was in small business, and I'm very appreciative of the opportunity that we had for retirement savings, particularly with two sons in college and the expenses that you have in life. It's important. I wanted to delve into an issue that you may be aware of, and this is the Department of Labor finalizing a proposal for a new definition of fiduciary investment advice under ERISA. It sort of gets at, Mr. Mesik, what your role is, but I wanted to probe a little bit further because I'm concerned about an additional hurdle for the type of people that can provide the information that small businesses need for their employees. So if this new definition prohibits plan providers from assisting small business plan sponsors in selecting and monitoring investment options, how would that impact your ability and willingness to offer a plan? And specifically, would it increase cost? What this new proposal is about is that they're changing the definition on fiduciary investment advice and making it more stringent so that people they would have to be highly regulated if they were offering that kind of advice. Yes, Mr. Mesik.
Well, we don't offer investment advice. I mean, we're just third-party administrators and record keepers, but intuitively, I might defer to some of my colleagues here, but intuitively that just may not, I don't think you want to make it harder on small business. It sounds like it might make it harder. And then they're just going to say, well, gosh, if I can't get any help, any assistance, and these things are expensive, it's just going to make it worse, potentially. But like I said, I'm not totally an expert in that specific area.
Right. I don't know if any of the other witnesses had anything to add to that.
I have a thought on this, which is I think the problem the Department of Labor is getting at is if you have a plan with an institution and you're dealing with a broker, it's probably human nature, or it may be human nature, that broker would try to steer some of the employees in the plan more to the institutional's products than some other institution's product, because the broker will get a greater commission. So I think that's the issue, and the question is this the best way to go about it? And my guess is it probably is not. It's a difficult issue. And I know, like, if every small business could afford to have an independent advisor, investment advisor, that would be the best way. But I would go at it almost completely the opposite way. I would say that a small business that has gone out and has found an institution that has X amount of assets under its investment, or that they should not have fiduciary responsibility at all at that point. So for instance, if I go out to, Vanguard or Fidelity or, name any of that is just by definition, that institution should be releasing me from fiduciary responsibility versus me going to my uncle who has, $1,000 under his own management, and I say, here, manage my fund. Well, clearly I've breached my fiduciary responsibility if I'm an owner sponsoring a plan.
Thank you very much. Any other comments? That was the gist of my concern, and I am concerned about this rule that it will make it more difficult, more expensive for small businesses to be able to offer plans. So on that, I yield back, and thank you, Mr. Chairman.
Thank you, Mr. Chairman, and thank you, panel, for being here today. A lot of you came a long way, and appreciate your expertise. I spent my professional career as a tax lawyer and a CPA. I set up a couple of these plans, but this area is so very complex that it got to where I would just refer these people out rather than setting these things up. It's a specialty under tax law, and even people who practice tax lawyers are such nerds that normal lawyers don't even want to do that. So it is a very, very complex area, and just my observation would be anything we can do to relieve that complexity and liability on small employers is what we need to do. Do you see these a lot of breaches of fiduciary duty in your practices? I'm just curious. Do you see that as a big problem, employers stealing from or mismanaging these funds? Do you see that?
I'll start, but I'm sure everyone should join in on this. And the answer is a resounding no in the small business area, because this retirement plan is the primary way that owner or owners are going to be able to save for their own retirement, because most small businesses can't be sold, or certainly not sold for enough money that they're going to be able to retire on it. And the whole world of non-qualified deferred compensation plans is not available to small business owners because of the tax code. So that means the retirement plan is their way to save for their own retirement. They've invested a lot of money into that plan. Why would they do anything that would jeopardize those investments? So to me, I've always sort of felt like if you want to look at fiduciary issues, you're in the wrong place when you're in the small business world. And sometimes I kind of bristle when I hear about the sort of notion that these small business owners are sort of these clueless blobs just out there without any idea what's going on with their money or their plan or, any of this. And to me, it's these are the folks who are running our entire economy to a large extent. These are people who have put their life on their line to start this business. Many of them have put their houses on the line to start this business. What makes us think that these people are incapable of understanding that they have got a lot of their savings in a retirement plan and that they're not going to take care of it? So I just start from the entirely opposite premise. I can't think of a time that I have ever heard or seen in my practice any issues with fiduciary responsibility.
Nor I. Mr. Mesik?
Oh, I concur. I mean, we work with lots of quality investment advisors, and they're picking the fund lineups from various places, and it's a total non-issue, never an issue. And I think every business owner is smart enough to know that I don't think I'm just going to offer a precious metals fund, and that's it. We'll be fine. So it's really a non-issue.
And Mrs. Collinson?
The thing I'd like to add is we're talking about small businesses and encouraging them to sponsor retirement plans. Our research has found that cost, administrative complexity, and concerns about the potential fiduciary liability are deterrents to them. And anything that we can do to help alleviate that is going to encourage them to sponsor plans and help their workers to save.
I totally agree. And I think one of the problems we suffer from here in this job as legislators is we think that we need to issue all these laws to protect people from things that just aren't real problems. And that creates all these strict guidelines and creates jobs for you and and myself as a tax lawyer and a CPA. And I think anything we can do to relieve all these strict requirements and regulations is what we need to do if we really want people to participate in this on a broader scale. Thank you very much for being here.
Mr. Payne.
Thank you, Mr. Chairman. Ms. Kalimath, you noted in your testimony that about half of new businesses survive their first 5 years, and only about a third of new businesses survive for 10 years or more. You also said that no matter how much a small business owner cares about his or her employees, and we know that they tend to end up being like family, offering a retirement plan is often a secondary concern. Do you or any of the other panelists know the percentage of new small businesses that offer retirement plans, and has a connection been found between a business's retirement plan offerings and its longevity?
Well, we have some data. We don't have, anecdotally, I can tell you in my practice, it's clear that once a business, it's not longevity as much as once a business becomes profitable and stable, then right away they move into the retirement plan area if they can. But we do know from this study that was done by Social Security, and it's cited in my testimony, that the size of the company makes a difference in how much coverage of how many of those businesses sponsor retirement plans, which is not surprising because the smaller the company, the more likely they are to be in that startup phase. So we know that 46% of small businesses with more than 10 employees but less than 25 offer a retirement plan. And we know 60% of small businesses with 25 employees but less than 50 offer a plan. It moves up to 70% when you have 50 employees but less than 100. Goes to 84% when you have 100. What we don't know in this particular study, we don't know the breakdown after 100. And most people think of small business as going up to 250 employees or 500 employees. So my guess is once you get up to the 250, you're at a level that's very similar to larger businesses. So that's sort of a half answer for you, but there's no question if a business owner feels like he or she or they are fighting for their lives and can't make payroll, it's just probably not a good time to start talking to them about setting up a retirement plan.
Right. Any of the other panelists?
Yes. In our research, when we ask small business owners why they don't plan to offer a plan in the next couple of years, the subject of business stability also comes up in terms of they're encountering difficult business conditions, which is a deterrent from setting up a plan. They're focused on staying afloat.
Okay. Yeah, please.
Yeah, it's been my experience that the entrepreneur, the guy that starts the business, is going when he gets profitable enough to start generating his own cash flow, he's going to want to save it. And that's going to be when he realizes the best way for him to save it is through this retirement vehicle. And that's when he begins thinking about spreading this across all of his employees, not only because of the regulations, but because, like it was said before, these are really his family. You know, they think about their employees as their family. And so it's not until they reach that profitability level that many of the people that I've been really, associated with really get into this opportunity, as it takes a while to get to there.
Okay. You know, also in addition to incentives, how do we build awareness and support so that small business owners make retirement offerings a priority?
I have one idea. This is once we've got a stable company. The folks who pretty much bring the idea of the plan and the understanding of the plan to the small business owners are very often the small business advisors. So it could be a CPA, it could be their attorney, it could be an insurance fellow that they work with, but to the extent we can educate these advisors about how important it is to set up the plan as soon as they can and how it brings along the employees and employee savings through the 401k plan or the feature, that's really an audience we need to target, is those small business financial advisors or their CPAs, attorneys saying, hey, you really need a plan, this is how you can do it. And, you know, there's this sort of, the laws surrounding the plans are almost ridiculous, and I could say that working with them for years and years. But a small business owner doesn't have to be an expert in retirement plans. They can go to an institution and they can find a 401k plan and work with somebody to get that plan set up, or they can go to a TPA or their accountant. So it's not like we're requiring the small business owners to become experts in retirement plan law. If that were the case, there would be no small business plans.
Thank you. I yield back, Mr. Chairman.
Mr. Hanna.
Thank you, Chairman. I want to ask about vestiges rules. What do most of you consider, and how are they handled within the plans that you have?
I'll answer that. Vesting, that applies where an employer makes a contribution, either a matching contribution or a profit-sharing contribution. They'll subject that money to a vesting schedule. And what that usually means is the most common one we see is like what we call a graded 6, 0, 20, 40, 60, 80, 100, so that after 6 years of employment, that person's 100% vested in that money. If they leave early, it's 5 years, 80%. So they leave 20% on the table. So it's designed to encourage some longevity with the employer. You know, it's that employee retention component. So it's a good thing. Now, in a safe harbor plan, money's 100% vested day one, and that's just one of the deals. So
right, I understand that what's going on. What I want to get to though is, if an employee, is it appropriate for an employer to use someone's vestige plan to create longevity? And if they earn the money the day they get there, shouldn't all plans perhaps be treated as safe harbor plans, especially in a climate where people change their jobs 7 or 8 times, as opposed to, you know, my father and myself? I want to ask another question. Ms. Kalimath, you mentioned that the top-heavy rule you thought was biased. I don't know if that was the exact word you used, but I'm very familiar with that. Why do you think that?
Well, for starters, it's based on the mathematical test, as you know. Mm-hmm. So if a small business generally has a significant amount of owners compared to employees, and so they almost always become top-heavy. And, I mean, once you're top-heavy, today, nothing much happens, because the way the other rules in the tax code operate, you still have the same vesting schedule. If you're a safe harbor plan, you're basically at the same 3% level. So it's like, but the reason why is because it's a mathematical test.
But you said it was biased. I take exception to that. I mean, I think that what it really does is it guarantees that a single ownership, one boss, 2 bosses, own the company, are put in a position where they can't treat themselves disproportionately better than their employees. And in terms of, we talk about things like fiduciary responsibility, there has to be some wall there to protect the employee, because this is all they have for their life as they save it going through. And a reference back to vestige rules. The other thing is that we all remember Bernie Madoff. I know that he didn't have a lot of small companies, perhaps a lot of individuals, but the world is replete with thieves in that particular business. Everybody looks good in that business. They all have the jargon down. So if you don't like that, if you'd like clean fiduciary responsibility rules, what do you do to save and protect the average guy who's working day to day, 8 hours a day, turns 55 years old and expects it to be there, and his employer borrowed that money out? Because we see every day the IRS are going after for people who take FICA money, don't keep it in a separate account, and spend it, go broke, and there's no recourse. So if you can borrow money out of a retirement plan, if an individual can go broke, you said leave their job and not pay it back, what about a business that uses it and can't pay it back and borrows it because they're already in trouble?
Well, very good questions, but let's go all the way back to the top-heavy rules, because if your point is you need some kind of rules to make sure that the employees get contributions in the retirement plan, the tax code does that without the top-heavy rules. That's why I said the top-heavy rules are just like an old appendage that aren't needed. So the protection is built into the tax code, but it's built in a number of different discrimination tests today. So 401A4 provides that kind of protection, and 401K provides that kind of protection. So the tax code does protect non-highly compensated employees.
It provides it if you use it, but you don't have to use it.
Well, now, if you're positing what happens if you have a small business owner who doesn't pay attention to the brokerage house or the insurance company or the TPA and says, I'm putting in whatever I want to, and by the way, employers are not allowed to borrow against their retirement plans. That's a prohibited transaction. Employees are allowed to borrow against their own account balances if it's at certain limits. But, if you're positing if a group of owners does everything wrong, well, are there folks out there? I'm sure there are bad apples out there. Surprisingly, you'd be, I was surprised how much DOL is all over that. Employees can call the Department of Labor and say, I don't think my company's running this correctly, and very often that will trigger an audit. So, but in my practice, and it may be because if owners are coming to me to say, how do I run my plan, then clearly they're not going to waste their money coming to me and then do just what they want. They just would skip coming to me and pay my fees. So, and I think that's probably true of everyone on this panel. Owners are not going to be coming to TPAs to find out what the rules are and then completely ignore them. I mean,
My time's expired. Thank you, ma'am. Thank you all.
Mr. Collins.
I want to thank everyone for coming. And Mr. Mesik, I think you articulated that business owners make a calculation as to, in some cases, their benefits of participating, and certainly that's one of the incentives if you get into a profit sharing or safe harbor contribution especially. But I just want to share a story and see if you've heard anything like this. The medical device tax part of Obamacare took place January 1. It's 2.3% of sales, not profits. We talk about a 401K profit sharing plan. If there's no profits, there's no 401K profit sharing plan. 2.3% of revenue in many cases exceeds the profits of the company and has wiped the profits out. So you could have a fairly profitable company making 2.5% of sales in profits. Now all the profits are gone. There is one local company in the Buffalo, New York area that terminated their 401K plan the first of the year as a direct result of Obamacare, of the medical device tax. They had no choice. They have no more profits. Now, we're early on the first year of this. I'm just wondering, would you see the sense of a company like that terminating their 401K when their profits are gone, as call it an unintended consequence of Obamacare, but a consequence nevertheless?
I'll answer that. Not that we have any of those types of clients that I can think of, but it's obvious if you're taking 2.3% right off the top, and that's obviously impacting your cash flow and your profitability, you're going to look for cost-cutting measures, period. And one of the first things you're going to do is you're going to look at the match in the 401K, because that's low-hanging fruit. You're going to say, well, yeah, we were matching 50 cents on the dollar up to 6% or whatever. Well, at a minimum, we're going to knock that back to 25 cents on the dollar or suspend it entirely. But you're right. The law of unintended consequences is a huge law and one I'm a firm believer in.
Yeah. Ms. Collison, do you have?
Yes, thank you. In the work that we do, our annual survey of employers, we also do trend analysis in addition to the snapshot that I presented earlier. And looking at what happened with employer-sponsored retirement plans during the worst of times from 2007 to 2012, there was actually some good news in there that employers were very, very reluctant to terminate their plans. What we did see was a significant percentage suspending or reducing their matching contribution, which any reduction in benefits is clearly disappointing. However, we did not see evidence of terminating their plan unless the business itself was going out of business.
Can I sort of take your question and turn it around a little bit?
Oh, not a problem.
Though I can say that both of the groups that I'm representing today are not in favor of the medical device tax. But when you talk about unintended effects, one of the things that we are very concerned about is in the analysis of how to reduce the debt, folks have spent a lot of time looking at this concept of tax expenditures. And the qualified retirement field gets a really big price tag next to the tax expenditure. And one of the things we are concerned about is if the amount of contributions allowed to retirement plan were to be cut back, or contributions being put into the plan now became taxable if your tax rate was over a certain amount. That might seem like, well, that's not going to have much of an effect, but in the small business world, that will have a tremendous impact, and it's because of what we've been talking about when the owners are going through this analysis. If, folks sort of forget that the owners own the profit, and they don't have to give it to their employees. They could take it out as compensation. They could put it back in the business, or they could do some mixture of those. Well, if the cutback to contributions in the retirement plan area is significant and you still have all the same costs and burdens, most owners, I think, would say, okay, we'll take out the money as compensation, or we'll put more money back in the company, but we're not going to put it in that plan because the plan costs too much. It's just not a good deal for us. And so what I'm worried about is, on one hand, saying, well, we're going to get all of this revenue because the tax expenditure number is so high, and at the other hand, you end up with this retirement security of millions of small business employees being affected, not the owners, the employees. And meanwhile, I think those numbers are really skewed because of the budget, the budget time period they're looking at. And if you ran out knowing that all that retirement plan money ends up coming back into the system again as taxable, I think you'd find that the real cost is the cost of the time value of money and not that enormous price tag they're putting on it.
Right. That's a point well made. I appreciate your comments and yield back, Mr. Chairman.
Mr. Holzkamp.
Thank you, Mr. Chairman. I appreciate you having this hearing today. There are some folks that think we're not working. We certainly are on the House side. There might be some misimpressions based on perhaps the other chamber. But thank you, gentlemen, for being here. I appreciate the gentleman from Kansas. I might take exception with Overland Park being a suburb of somewhere in Missouri. But I'll visit with the governor about it. I hope you do live in the state of Kansas. The tax rates are very different, Mr. Chairman, as you know. But with that, a couple questions. I think it was mentioned about the regulatory burden on what you all do that are in the business of advising and helping out. Give a few examples. Can you repeat a few of those examples and others that you say, hey, this is a significant burden to limiting what small businesses are willing to do and the cost and the type of paperwork and things that, as I always say, the longer the paperwork, the less likely folks are to read it. And you probably see that. Could you give a few more examples and describe more? And I will ask at the end that you provide that stack of stuff that's required for the employer and the employee later to the committee. So if you could share some more information on that front. Whoever would like to answer that.
Well, I'll give you one example, and I'm sure the folks to the right and left of me will be able to give you some more. One is this thing called interim amendments, and right now we're not getting hit with them that much, but that's simply because there hasn't been a number of laws recently in this area. But what has happened is you all would pass a law, and IRS would then do their regulations on it, and then IRS would say, okay, you have to go amend your plans now to incorporate the changes we just did in our regulations, which then meant in the private practice world, and this goes to the huge institutions as well, so they may have 20,000 plans. They're sending out 20,000 of these interim amendments. You end up with an amendment going to the company that is, frankly, just gobbledygook. I mean, I could line up a bunch of ERISA experts and they'd say, who knows what this means? I mean, it's that bad. So, we're dancing on the head of a pin. This amendment gets sent out to the owners. There's usually a price tag with that amendment because everyone can't do this for free. And you end up with owners saying to the TPAs or the institutions, what does this mean? why are you giving this to me? And I'm supposed to hand this out to my employees, and they're supposed to make sense of this. So this was happening year after year after year, and the costs were getting significant, and you had a number of small business owners who don't like notices to begin with, let alone nonsensical notices. And it was really getting bad. Now, IRS is trying to figure out how to work their way around this, but one easy way is for you all, anytime you pass a bill where you're trying to help us out, which you do on a fairly regular basis in this area, it would be great to have something that says, and by the way, no amendments are required to plans until the next time there's a restatement, or for 3 years at least, or something, so that at least we have some breathing room from this kind of churning of crazy amendments. So that's an example.
On the issue, follow up on that, on the issue of paper versus electronic, that all has to be paper, or in this particular issue?
Well, right now, the default is paper, and the default should today be electronic.
Amen.
And if, I don't know how many of you have looked at the required fee disclosure notices that were handed out to employees. I mean, what a waste of trees. And it's just a shame because, 10, 15, 20 pages of a notice, well, there's not, very few employees around who are going to be wading through that. If it had been done electronically with maybe a chart right in the front that someone could look at, we had a chance of them looking at it.
Other comments? I had one other general question. And do you see from the folks you work with any difference, generational differences? If you're 30 and under, 40 and under, if you aren't doing this, you are out of luck. I mean, is the message getting there yet? Where are we at for younger folks, which are going to be having to heavily rely on this, given the incapacity for Washington to meet these promises they made? Yes. Listen.
Okay, one thing that we found in our research of workers, comparing and contrasting the retirement outlook of different age ranges, and something that's really quite startling is workers in their 20s share very similar levels of retirement confidence as people in their 50s, which are presumably mathematically right about their parents' age. And what seems to be happening is workers are inheriting their parents' gloomy outlook. And part of the messaging that we need to work together to do is they have years, they have decades to plan and save, and they can change their retirement destiny. However, they, one, need to be shown the possibilities, as well as have the ability to learn from their parents' successes as well as missteps so that we can change the course of history. As we are looking towards legislative and regulatory changes that can help facilitate that, the clock keeps ticking, and it's up to each and every one of us to take greater levels of ownership of our own retirement outcomes.
Well, thank you. I'd be happy if you'd provide a link to that summary of those attitudes. I'd be very interested personally looking at those. So I yield back. Thank you, Mr. Chairman.
Mr. Luke DeMeyer.
Thank you, Mr. Chairman. Just kind of curious, one of the statements that was made in one of the testimonies today, and I think it was Ms. Collinson, if I'm not mistaken, with regards to people working past 65, there was some kind of interesting numbers there. It was like 59% people anticipate working past 65. Is that correct?
Of the small company workers, yes.
Okay. Is this? Do you have a reason for that, or are they just they need the extra money? They're not ready to retire yet. They just enjoy working. All of the above.
In most cases, it's because they need or want the income or benefits.
Okay. So at this point, the retirement benefit is not something that's attractive to them? Not a reason to retire?
They can't afford to retire.
Can't afford to retire. Okay. It's kind of interesting from the standpoint that we have a retirement program sitting there, and they're not wanting to take advantage of it because it's not good enough to retire on.
Well, just to be clear, that's all small company workers, regardless of whether they're offered a plan or not. And even those who are offered a plan, the majority of workers of small companies and large companies are expecting to work past age 65 or not retire simply because they're afraid they haven't saved enough. And looking at account balances, I referred to the $92,000 median among baby boomers of small companies. They need to keep working.
Mm-hmm. With regards to the small businesses, I mean, they're taking a pretty good hit over the last 3 or 4 years. A lot of them probably can't financially afford to build into their business plans retirement benefits for their workers. I'm just kind of curious: is that am I right in that? Is there a trend toward less retirement benefits for their workers, or are they being able to maintain that? Or, sir?
Yes, I can speak to that. It goes back to profitability. It's not a desire to not offer it to employees. It's when I'm being asked to match in a time when the business economy is slowing down and my sales are going down, my margin's going down. I've got 1 or 2% to begin with. And so it's no different than your question about the employees. Why are they not taking advantage of retirement when they're worried about their retirement? It's because today is more important than tomorrow. So these workers can't, they get to the end of the month, they don't have enough money, so let's put $100 or $50 away. Well, that's just going to have to wait. It's the same way with the employer. My profitability is going down, and so my contributions to my employees' retirement is going to have to go down.
So what you're saying is retirement benefits are great things as long as you can afford them.
That's right.
Whether it's the employer or the employee.
That's exactly right.
Thank you. I'll yield back. Thank you, Mr. Chairman.
Mr. Mulvaney.
Thank you, Mr. Chairman. I want to ask a little bit different line of questioning, just out of curiosity. I've run several small businesses before I was here. Some of them did well enough, to your point, sir, about to being able to offer these types of benefits to the employees. Others didn't. They weren't big enough. They didn't make enough money. I ran a restaurant, for example. We didn't offer retirement. And I would see these young people especially, but also we had folks at the upper end of the age scale, but young people especially coming in who weren't saving, and I didn't offer them anything, couldn't afford to do it. How can we, as small business people or as a small business community, outside of the realm of an ordinary employer-sponsored plan, how could we encourage younger folks to start participating in these plans on their own? And I'll throw that open to everybody, because I don't know the answer to that question. I'm curious about it. I'll ask the same question, by the way, you're thinking about older folks. We had folks come in who were near retirement, wanted to work just a little bit more, and they didn't participate either. They wanted to save a little bit extra, but figured, well, it's not worth it because I can't put enough away in a short period of time to help. So I'm curious about both ends of the spectrum, just if anybody has any thoughts on that. Yes, ma'am.
We have one thought, which is we call it the Kid Roth. And the idea is today, for people to make Roth contributions, there has to be earned income. And if you took away the earned income requirement for people, let's say, who are under 21, and you allowed, a 2-year-old is allowed to have a Roth, and you could have grandparents and parents and aunts and uncles making small contributions into this Kid Roth for that person, and you would have some special rules. So you couldn't take money out of this plan till you're 65, let's say. Or maybe you modify it somewhat, but once you reach 65, you could take money out of it and get only capital gains treatment instead of ordinary income. Just sort of ways of using the tax code to inspire people instead of buying, the latest, newest toy. I'm going to put some money into this Kid Roth. So that's an idea.
Ms. Collinson?
Well, one thing that we can do if a qualified plan or a retirement savings plan is not available to the employee is most employers now use a payroll service that offers direct deposit.
Correct.
And direct deposit into multiple accounts. Well, what we can do is help educate people on the need to save, and better yet, save for retirement. And when they set up their direct deposit instructions, to set aside a certain amount that goes to savings, that goes to a savings account or an IRA, and the balance of their paycheck to go to their checking account. And by virtue of that, they're automating a certain element of savings, setting it aside every paycheck. And for many people, once that money is in a savings account or an IRA, it is much safer from withdrawals than in a checking account for many it's fair game. That's just a very simple trick to get in the habit of
But
savings.
that's available now and that's legal. What you mentioned, ma'am, was not. That's just an idea going forward.
Right. It would require some changes to the laws.
What about letting the kids opt out of Social Security? What about letting new folks who come in say, look, I'm going to waive my rights to Social Security, but I'm going to take that same 6-7%, I'm going to put that into an IRA for myself, under the theory that, historically speaking at least, they'd be better off over the long run. Plus, they can choose when they want to retire, 62, 72, 82. It doesn't make any difference. What do you think about that? And I would address you by name, but I have no idea how to pronounce it, so I'm not going to try and embarrass myself.
That's fine. It's
and since I sit next to Mr. Lutenmeyer and my name is Mr. Mulvaney, we feel your pain. So
That's right. Yeah, they pronounce it Rux Daschle.
Yes, sir.
We've seen that already. In Texas, the Teacher Society opted out years ago from Social Security. They had their own Texas teacher retirement. They have their retirement plan, and they cannot benefit from any Social Security. Of course, my wife is bitter about that she gets none of my Social Security, but that's another issue. But in that particular case, if they can see, they can take that money that probably to a young employee today is skeptical that they'll ever see it in Social Security. If they can see they're directing it, I think that's a very strong possibility.
I mean, I understand what you're saying, and it certainly has some merit, of course. The problem with it is that Social Security is a defined benefit system. It's an annuity system, so you can't outlive those payments. And the qualified retirement plan system today is largely a defined contribution system. So the two are sort of dovetailing quite nicely right now. I could see some people being concerned that if you went only to a Social Security system where it was based on contributions going in and not a guarantee that you would be getting annuity payments throughout your lifetime, that we would have removed a safety net for some people.
Thank you very much. Appreciate your participation. Thank you, Mr. Chairman.
Well, I want to thank all of our witnesses for being here today. Obviously, saving for retirement is always going to be a challenge, I think, for Americans. And with an aging workforce and uncertainty in Social Security, I think it's more critical than ever. But with that, we appreciate the new data and everyone bringing in your ideas and thoughts. And we're going to continue to monitor this issue. And with that, I would ask unanimous consent that all members have 5 legislative days to submit statements of supporting materials for the record without objection. That is so ordered. And with that, the hearing is adjourned. Thank you.